Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
Let's begin with the good news. That is, God is for all of us. That's right, He's for all of us. He's not for everything we do, but He is still for us. Black, brown, white, Republican, Democrat, rich, poor, believe it or not, He's still for us. And you know what? The other news is we can make the world a better place together, each one of us, if we will be for everyone and still not be for everything. We don't have to be, but we can be for everyone. And I want to encourage you, because I'm going to live this way. And if we do, I really do believe we can make the world a better place. And that's what we should be doing. Why? Because we live in the greatest country on the planet. Flawed? You better believe it. And we get to see it every single day, don't we? In the news. But the good news is, if we do our part and really go out of our way, be intentional about being for everyone, still not for everything, but be for everyone, we can then not divide our house, our country, our family. We can bring it together. And that's what we should all be doing, because every kingdom that's divided against itself is brought to desolation, and we don't want that. That is our country. We don't want desolation. It's not very good for the housing industry. So we want every city and every house to stand together, even if they don't agree on everything, and that can indeed happen. All right, let's go to the news. We induced an economic coma. That's right, we induced it. We actually intentionally decided to shut down our economy for the first time ever. And we did it because we have a pandemic called COVID-19, coronavirus. And we had to, in order to keep hospital beds available, respirators available, we had to slow down the effect of the growing virus called COVID-19. And so we induced an economic coma for the first time ever. And you know what? We knew when we did it that it was going to be a challenge to climb out of it, to turn it back on, get it to restart again. But we also told you, and we continue to now, keep a watch on the things that we thought would need to be in place for the road to recovery, getting the economy to get back on course where we left it in March prior to the induced coma, one of the best economies in history. We want to get back there, right? So all of us can thrive in any industry, essential or non-essential, right? Because everyone's essential. Of course they are. Anyway, monetary policy, we knew it was going to be a big deal. The Federal Reserve in control of monetary policy in our country. We knew that fiscal policy, that government in Washington was going to need to act. So we knew both monetary policy and fiscal were going to need to be on their game. And finally, we were going to need the scientists, doctors to really work with the government, with private and public together to work towards getting all of the testing and the vaccines and the remedies, all of them on course to fight COVID-19. The Federal Reserve, as we've told you in the past, they've done anything, everything, and then more than that to essentially take monetary policy and position it in context with a once-in-a-lifetime event called shutting the economy down or putting it in a coma. So they've done exactly what they need to do at this point. And they continue to be a substantial advocate on the road to recovery for this economy. Let's move into stimulus. They've done everything. That is Washington. Believe it or not, they finally got together and they actually agreed to do some things. Why? Because we had urgency, a real sense of urgency, and they did take action out. Did they do all the right things? They did a lot of great things, and then there's some unintended consequences that in the news sometimes we tend to focus on. But the truth of the matter is, whether it was in unemployment subsidy, whether it was in the PPP program, whether it was in stimulus checks, and they are still now effectively thinking about another stimulus. They've talked about waiting till July so they can let some of the stimulus settle, and then they're going to be back at the table, I am certain, to continue to give fiscal support to the recovery that we're all on right now. The shutdown, according to all of the health experts, and of course there is news in the health community, and then sometimes they change that news. And why? Because this pandemic, COVID-19, and the doctors and the scientists that are focusing on it, it's dynamic. They've never seen this particular version and this particular event. And so when they go to work on it, there are things they believe, they share that with us, and then sometimes those things actually change on time. You know, once upon a time we thought coffee was good for us, then we didn't, then we did, then we didn't. Similar kind of idea. All right, so the spread was effectively slowed. We flattened the curve. And recently now, as we've begun to reopen, the fear has been that a second wave would be unleashed. In other words, if we didn't open the right way, who knows what that looks like, right? Well, they've tried to tell us that a second wave would be effectively unleashed. What we are hearing from the best scientists and doctors is what we're experiencing is not a second wave. We're actually experiencing the first wave still. We tempered it. Now we're opening again, which is less social distancing and less quarantining. Businesses, people are coming together. So naturally, you would expect we'll see some increases along the way. Mostly, if we continue the disciplines, we should see that flattening remain. And all that does is give us really hope so that the scientists and doctors can start getting answers. And in fact, there's a drug now, Regeneron, which they're now saying we have a lot of hope for, that it could actually potentially, at least in a lot of cases, curtail the event, that is, so that it keeps from hospitalizations and generators, et cetera, et cetera, et cetera. And there's a number of people working, companies, the best in the world, on vaccines right now. So we are full speed ahead and trying to get to real solutions. So we'll just continue to hope and pray that they do the best work and we get there. So by the time we get to the fall, we actually have some answers for these questions. Let's get back to the economy now, news you can use. The reopening of the economy, we do have liftoff. All of the states are open more or less at this point, but we just don't know what reopening and what the outcomes are going to look like. So we'll be here every week to tell you exactly how it's going. Right, so hospitality is now getting reopened, retail is getting reopened, the airlines are reopened, restaurants, bars are to a great extent reopened, and now we'll see what the recovery is actually going to look like. From the very beginning, we told you there's basically 4 theories about what the recovery will look like. An induced coma to getting it out of a coma. It'll either be a V, which we all hope for, which is an immediate bounce back to where we were. Most people at this point, most economists don't believe it's going to be a V. So let's go to what else it could be. It could be a U, which is we went all the way down and it takes a little time and then we make the recovery. Could be an L. We don't want that. L is the last thing we want, okay? L, last. Yeah, that's a crash and then we just never recover. And finally, there is the Nike swoosh. Again, they must have paid an awful lot of money to get into this conversation. They're a great marketing organization. I'm sure they paid a lot of money. But anyway, that is where we crash and then we come back over time. So what we really want is the V, and a number of different industries are now starting to show themselves to give us some indication what it's going to look like. The Fed, that is the Federal Reserve, they have banks 12 around the country. They're local forecasters because they all have different regions. They have a massive amount of difference in their view. The biggest thing is it going to be a continued recession? That is the one that we're in, because we are now in recession where we have negative growth, a self-induced coma. So the question is, how long will that last? Or will we come back like the V and go back into a boom kind of economy like the best since, the early 80s? So those are the varied views of the Federal Reserve's banks around the country. And a lot of it has to do with what they're seeing regionally based on the types of businesses that exist in the various regions of the country. Because again, our country's not a one-size-fits-all economy. There are many different industries that concentrate in different regions, and so those industries are recovering at different paces, and therefore the local Fed banks are seeing different information. So that's why there's such a wide view on what's going to happen next in terms of forecasting. Let's move on. Weekly unemployment claims, a big deal. Why? Because the most important propeller on the economy is someone with a job, because someone with a job gets paid every other week, every day maybe, and they take that money and put it to work. That's 70% of the entire economy. That is us, you and I, going to spend money, and we get that money from hopefully working. That's the best place to get it from. Well, last week we had the lowest unemployment claim week on Thursdays. Claims are released. We had the lowest one that we've had since COVID started. We had 1.5 million file. You know, that's a lot of people, but we were as high as 8+ million during the height of this process. So we've certainly flattened and reduced the curve down. And by the way, the total number of continuing unemployed, that's a big number, because there's people who file and then they get their jobs back and they come off of that number. So the outstanding continuing claims, they went down as well. They went down to 20.9 million. That's still a lot, but it's off of 22 million just a week earlier. So progress being made in the employment market. And why is that? Because industries like hospitality, leisure, and construction that were shut down completely. Travel shut down completely. Hotels basically shut down. Bars, restaurants, all of those people suffered the worst employment impact because of our quarantining and the fact that they were just not able to be up for business other than to let you come and take food from them. Anyway, in those industries, 2.5 million jobs have been added back. So that's where those continuing claims, we're starting to see the industries that got hurt the worst are starting to hire back the fastest. And that is very good news for the recovery. So let's get a little bit more detailed on that. Airbnb bookings up. Airline increased schedules up. Disney reopened, so they're reopened now. We're going to start seeing traveling again. Vegas opened sooner than we expected. Sales and rentals, basically RVs, are booming right now. People opting maybe to fly a little bit less, but they're still getting out and traveling. And we're seeing with TSAs, we're seeing screenings continue to increase, which is an indication, of course, that there is more travel taking place. All right, let's get a little bit more detailed about some of the what we're watching, okay? Because I think these are important. As we told you last time, what an interesting world we live in today, that one of the economic indicators that we'd be looking at would be Apple Maps and Apple Maps usage. That's because we actually go out of homes again. We used to, then we didn't, now we are again, right? So people are getting walking directions, driving directions, a really good sign, because that tells us that people are getting more active again. And where are they going? On the right, they're going to restaurants. They are now starting to book restaurants again, and if you've been in one, I have, they're starting to make a comeback. So are they where they were when we started this whole event? Nowhere near it. You can see that on the graph. We're still about 65% off of this time last year bookings. Air travel, probably the slowest of the slow to recovery, and so we need that to actually move as well. But RVs are up, so that's good news. People are just getting there a different way, at least for the short term. And hotel bookings are as well on the incline. If you look at the restaurant bookings and the hotel bookings, they look a lot like the Nike swoosh, right? And so those were the biggest impacted businesses. We still have air travel looking a bit like an L, but it's starting to shape a little bit more like a swoosh. But those were the industries that were most impacted, so it's going to be true that they're going to take a little bit longer recovery. Guess what? Other than Zoom, there's at least one business industry that looks like a V. It's our business. Unbelievable that our business would have been allowed to stay open. That was good, but we still didn't look like we were open, did we, in April? But since April, we've had an incredible run in real estate. And in fact, year to date, we're up 13%. 13%. That's one of the best years at the mid-mark of the year, which we're coming up to right now, that we've ever had in housing. How about that? An amazing idea. Now, the end of the graph, it starts looking like it's going down. Don't look at that. It's Memorial Day weekend. There are, of course, ebb and flows, period, that are going to take place based on certain things that happen during the run of the season. But this is a great indication that our business, other than having very little inventory, still even worse today, that we're now starting to see an awful lot of that demand that we started the year with is really going to work now. And as we recover, open up, housing is going to have to lead it. And in fact, if I look at housing as always being an indicator, by the way, housing is 20 to 25% of the American economy. So when you think about looking like a V or even a U, which would be good too, housing is showing itself as a leader right now. And I'm believing that unless we have some other disruption, which we've got some things that could be disruptive right now, right? We'll hope and pray if everybody's for each other that we'll get through those things. But the truth of the matter is housing is showing itself as leading, so we'll hope all those other industries are following at this point. The Fed came out in the past week and told us that interest rates are basically going to stay very, very low, historical lows, which is where we are right now, through 2022 in their estimation. And they believe that the next year we're going to have a 5% GDP. That would be one of the biggest ones on record. That's gross domestic product. That's the total of all sales of goods and services in the United States of America. This year we're going to be negative on GDP, which is why we're technically deemed to be in a recession right now, with the exception of housing, because housing's not in a recession right now. But the Fed is talking about low interest rates, historical lows, being kept through 2022. Good news for our business, by the way, and that they expect to see a pretty robust rebound in the whole economy next year. That's good news for us as well. This past week, and this is where I want to shift a little bit today. This past week, we heard that mortgage rates had gotten to an all-time low, and in some cases publicized below 3%. And that could be true if you have a certain profile and you pay a certain amount of money. But I want to make sure as realtors, because part of our job on News You Can Use is to share education with you about housing and housing finance that you can use and be beneficial then in serving your customers in a better way. And so we want to make sure that you understand the things that are happening in housing and housing finance. And we'll get back to interest rates just here in a minute. More good news. Demand for mortgage bailouts, forbearance demand, is now down again. So we're still seeing reductions every week in the number of customers who are saying, hey folks, I need help, not to forgive my payments, but to restructure them because I'm hurt by COVID. So that was what the stimulus CARES Act, one of the components was that forbearance would be afforded to consumers so they wouldn't lose their house or go delinquent on their mortgage just because we induced the economy in terms of shutting it down, that they would lose their job, they would lose their house. The government in its stimulus program accommodated that not happening. So we're starting to see now those numbers decline for the first time. That is, forbearance requests are going down substantially, and we're hoping that that continues to take place. And we would expect, as employment continues to build momentum, grow back towards where it was back before we started this process, that we will see forbearance numbers, the requests come down, and the total outstanding in forbearance would come down as well. Housing market still has one big challenge, problem, and it's not getting better. And that is that credit, anytime the credit industry sees unemployment at 13%, it's going to tighten because it's worried about delinquencies. I don't care if it's in credit cards, automobile industry, or in housing. So no different this time around. When we saw the events unfold, we saw pressure on FICO scores going higher. Many of the jumbo mortgage lenders just pulled out completely. Many of the companies, the biggest banks in America, pulled out of doing equity lines completely at this point. So we still have a real pressure cooker on credit in our industry. And by the way, when we go from 3.5% unemployment to 13% unemployment, people sometimes miss credit card payments or car payments. They don't have to worry about housing payments now because if they have one, they could go into forbearance. But what does that do? It reduces credit scores at a time when we need to increase credit scores the economy set up is to help reduce them. And so, with that challenge outstanding, Supreme created a program called Credit Essentials. We run it every Friday at 1 o'clock with Lisa Myers, who is now revered in everyone that she deals with, because she's like a credit whisperer. She actually on Friday at 1 o'clock spends a half hour with your customers, if you invite them to come with us, and basically explains what's in the black box of credit so that they understand, consumers understand really the mystery of how their credit score is created. And then they can take action to improve the credit score. Sound like a good idea? Of course it is. So refer your customers to Supreme. We'll refer them to the program on Fridays at 1 o'clock. And we will together then add value in the lives of our customers, which will make them raving fans of us and build our future business. Sounds like a good idea? Of course it is. That's news you can use. Anyway, credit, let's take a little bit deeper dive. I want to introduce you today to a housing industry acronym. It's called LLPA. That's Loan Level Price Adjustments. What that means is when you hear, or your customers hear in an article that interest rates are now 2 7/8, that may be true, but it has everything to do with the customer and the transaction, and I'm going to explain that. Here are the things that drive the cost of money. Your credit score. That's why send your customers to Lisa Myers so we can get it to go higher. Your loan to value, how much money you put down. If you put down more, we charge you less. You put down less, we charge you more. And it's not us, it's Fannie Mae, it's Freddie Mac, it's FHA and VA. And why? Because delinquencies are directly affected to these profiles. That's why there's risk adjustments. Loan level price adjustments are risk adjustments. The higher the risk, the higher the price, the higher the rate. Property type condos are deemed to be riskier investments than are single family detached. So what happens is if you select a condo, you're going to get an increase in your interest rates. Loan amount, that's another impact. You go way down on loan amounts to like under $50,000, you pay a lot more for money. Simple as that. Occupancy status. If you're moving in with your family, owner occupied, or you're a second home, or you are a investment property, all of these things matter. Let me get you up close and personal to how big the matter is, right? So on the left, you see credit scores over 740 and then 720 to 739, all the way down to 620 to 639. And then at the top, all the way across the top, that's the loan to value, how much money people are actually putting down on the property. So you can see with an over 740 credit score, upper left corner, over 740 credit score, 60% or below loan to value, you pay no LLPAs, no loan level price adjusters. So you have the lowest rate in the market with 40% down and over 740. As you go to the right with that same customer, over 740, 60 to 75%, you pay a quarter. All the way a quarter of a point. So on a $100,000 loan, it's $250. On a $200,000 loan, it's $500. All the way to the right with 3% down, you pay 75 basis points. So on a $200,000 loan, that's $1,500. So even if you have a really high credit score, but you put down the least amount of money, you have an LLPA because of your loan to value, and that is 75 basis. And this is not Supreme's LLPA. This is Fannie Mae, Freddie Mac charging us, which then, of course, that charge through goes directly to the consumer. So you can see on the left, the credit score, as you go down on credit score, even with 40% down, you pay an LLPA. But as you go across and go up the loan to value with a low credit score, look at the amount of money. On a $200,000 loan, 3.5 points, that's $7,000. But we're going to take it down to what it really is, which is it's charged in interest rates. So these are some common LLPAs as we would communicate them in our industry, and we use that all the time. LLPA, well, that's loan level price adjustment. But I want you to see it because you need to understand that when your customer wants to waive escrows, as an example, we'll have to pay for it. It's a quarter of a point. when they want to buy or have a repair escrow that's put in place at closing. There's an additional charge. So there's a number of different things detail-wise other than just credit score, other than loan to value, other than property type, and other than usage, owner-occupied versus investor. Let's take this down to real apples and oranges. Scenario one, we have a condo purchase. Primary residence, owner-occupied, 30-year fixed rate. Cool. All right. Let's talk about our customer. On the left, we got a 680 credit score, 5% down. The total LLPAs are 2%. If we don't pay it in cash at closing, the interest rate today is 4 7/8 because those LLPAs get increased into the interest rate, or you can just pay it in cash, 2%, and you'll have the lower rate. But if you don't want to pay the 2%, which on a $200,000 loan is $4,000 at closing, and they're only putting 5% down, they don't pay it. So when you hear us tell your customer their rate could be 4 7/8, and you go, wow, that sounds high. It's not. It's the LLPAs driving it up based on the profile of the transaction. 680 credit score could go higher if they go to Credit Essentials on Friday, 5% down, and a condo. Add them together, that's what you get. On the right-hand side, you have a 740 credit score. They went to Lisa Meyer's class. 25% down. Lisa did not give them the money, by the way. But the total LLPAs dramatically shrink. The same property they're buying, condo, customer higher credit score, customer more down payment, you got a 3 3/8 rate. So when you hear these things, do know that the rate is not a one-size-fits-all rate, because it's not. Let's go to another example. This is scenario 2. Single family detached, okay? So there's no premium on that LLPA. But let's look at different single family. It's a second home in one case, investment property in another. In one case, 10% down. Another case, 20% down. One case, 700 credit score. The other case, 700 credit score, equal there. Total LLPAs on the left-hand side, second home, 10% down, 700 credit score, 1.25. Total LLPAs here is substantially different, and as a result, because it's an investment property, okay, we have a dramatically different interest rate, and that is that it's 5.25 versus 3 7/8. And why are these LLPAs so high? Think about it like in insurance. Smoking, not smoking, having a DUI on your record or not. All of these things factor in to our industry, meaning that investment properties go delinquent more than owner-occupied. That's just a fact. Lower credit scores go delinquent more than higher credit scores. Lower down payments go delinquent more than higher down payments. So all of these things are historical in nature, statistically driven. They come back in the form of LLPAs to us, and therefore on the same property that you sell, based on the customer's profile, the rate today could be 3 7/8 or 5.25 because of the nature of the profile. Let's go to scenario 3 so we can continue this conversation, because it's very important that we address this for you so that you have better information for your customers. So when they say, wow, that sounds high, you can say, well, that's because of LLPAs, loan level price adjustments based on the profile of the transaction. That's what News You Can Use can do for you, right? So primary residence that we're dealing with here, 30-year fixed rate. On the one hand, we have single family. We have a 20% down payment, 720 credit score. Escrow account is included. They're not asking us to waive it, so we're going to collect the taxes and insurance monthly. Total LLPAs, 75 basis points today. That's a 3.5% rate. You can have a much higher credit score and get the rate down. That's a fact, okay? That's the way that can work. Higher credit score, 25% down, you'll get the absolute lowest rate. All the way on the right, it's a duplex, not a single family. 20% down, 720, no escrow account, so they're waiving escrows. Now the LLPAs are 2 instead of 75 basis points. If they don't pay it at closing, we fix it into the rate. Instead of 3.5, we're talking about 4 1/8. So you can see there's a substantially different outcome, interest rate offered to your consumers. So when they read that article that rates are supposed to be, 3 or below for me, it all gets back to what I just described. These slides are available, by the way. We'll make them available through the LOs. Just give us a request so that you can see them, because they're not, again, Supreme's loan level price adjustments. These are industry-wide adjustments to go on with every single lender, because the agencies that buy the debt, Fannie Mae, Freddie Mac, and Ginnie Mae, FHA, and VA, they charge us, and it's a pass-through cost, and to the consumer then. Regardless of the scenario, no matter where you want to take this conversation, your clients save money if they have a better credit score. And Lisa, Fridays, by the way, she meets with everyone. And then afterwards, if your customer wants their own specific roadmap to improve their own specific credit score, Lisa does that for us and for you. And so not only can you sell a house and deliver great service in that way, and deliver great service by referring a great lender like Supreme, but your customer can also improve their credit score, which they're happier with a better credit score. You're going to have been the one who refer them. They're going to be able to get their cost of credit cards down, and their cost of automobile loans down, and their cost of home mortgage lending down. All right, let's move on to the Supreme Rescue Service. That is, we have a specific unit. The best of the best of the best risk managers in the country. And so if you have a transaction that's stuck elsewhere for any number of reasons, it could be because the underwriting there just doesn't get it, okay? A lot of times they just don't. The reality is, get us involved. We'll get a second opinion very quickly for you. And oftentimes we can take the issue and find a resolution, path that resolution, and get that transaction unstuck and be the Supreme Rescue Service at your service, bringing an additional transaction to your total for the year. And of course, making another home buyer in America, which is a beautiful thing. Our stats say it all in customer service, and we've got these stats and we don't mind sharing them, because you know what? We want you and your customer to know about this, because frankly, if your customer picks a big bank today, it's going to take 50 days and they cannot guarantee you will close on time. That's a fact. You know it and I know it too. So these are the kinds of data points that if they were to call one of those big banks and say, well, what's your customer satisfaction? They're not going to get the numbers because they usually don't track it. How often do you close on time and fund on time? A kind of big deal in our business when people are moving trucks, sellers needing to get on to buy the house, the domino effect. The reality is, close on time, fund on time. We have all the data points. And then finally, we can go in 8 days, and many of you know that because we've driven that fast with each other in the past. 8 days, that's right. So close on time, fund on time, get you paid on time. We'll go really fast. You need your loan rescued, call us. We built this entire service system because we know exactly what you do. We are focused on the purchase money mortgage business. Oh, and by the way, as of last week in America, just under 70% of all the loans, mortgage loans that were being done, were refinances. We don't do 70% of our loans as refinances. Ours are less than 20%. Why? Because we focus on your business. Why? We want to be expert at delivering the industry's best experience to you and to the home buying community. That's what our focus is strategically and otherwise. That's what we want to do. Last week, in America, took on average 50 days, 51 days to get a loan closed in this country. 51 days average in the country. Again, we know this is not the winemaking business. We're just making mortgages. So we don't think it should take as long as it does to make wine. 50 days. We think we should be able to make mortgages much faster, and we do. 21.9 days was our average last month. Oh, and by the way, half of our loans happened in 10 days. Here to there. Why? Because, as you know, some transactions just require more speed. And this is the way you can drive, if you'd like to, is Supreme. There's a lot of people looking to buy very little inventory today. Sometimes speed makes the difference with the seller. Well, if you want to go fast, like in 8 days, get in our car. We'll drive you that fast. Really. It'll be smooth too. We have great seatbelts. You won't even know it. And you'll get right to closing. We started today with, all of us did. We started with COVID. And that's one of the reasons we're here with news you can use today. We also started with the challenges that we all face today with our brothers and sisters in the country. And I hope we all started with the idea that we want to get better every single day so we can be better humans and we can invest with our brothers and sisters better. I do. I know you do too. And so if you just lock into this thinking, I'm for everyone. I am. I want you to be too, even those that are hard to be for. But I'm not for everything. Neither are you. But we could still be for everyone, even though we're not for everything. Let's not be for people if they're for what we're for. That's too easy. The harder thing to do and the better thing to do is to be for everyone. Even when we're not for all of the things that they're for, we can still be for everyone. They are our brothers and sisters, black, brown, white, Republican, Democrat, rich, poor, believer or not. That's what we should do. And if we do, we'll make the world a better place. That's news you can use today. We'll see you again next week.